Ladies and gentlemen, good day and welcome to Yasho Industries Limited Q4 FY26 earnings conference call hosted by MUFG in time. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Sejal from MUFG in time. Thank you, and over to you, ma'am.
Tha- Thank you, Yusuf. Welcome to Yasho Industries Q4 and FY26 earnings conference call. From the management today, we have Mr. Parag Zaveri, Managing Director and CEO, and Mr. Chirag Shah, CFO. Before we proceed with the call, I would like to give a small disclaimer that this call may contain certain forward-looking statements which are based on business operations and expectations of the company as of today. These statements are not guarantees of future performance and involve risks and uncertainties which are difficult to predict. A detailed disclaimer has been given in the company's investor presentation, which is uploaded on the stock exchange. Now, I would like to request Parag sir to give his opening remarks. Over to you, sir.
Good evening, everyone, and thank you for joining us for the Yasho Industries Q4 and FY26 earnings call. We appreciate your continued support and engagement. I trust you have reviewed our financial results and investor presentation. FY26 was marked by a challenging global environment for specialty chemicals with tariff disturbance, geopolitical tension, supply chain volatility, and cautious procurement trend impacting demand and pricing. Despite these headwinds, Yasho Industries delivered resilient performance through disciplined execution, strategic decision, and operational efficiencies. Consolidated revenue reached rupees 830 crore, up 22.7% year-on-year, while EBITDA stood at rupees 144 crore, with margin improving to 17.4%, supported by product mix, operating leverage, and cost optimization. Exports contributed positively, while industrial chemical segment remained the key growth driver. We strengthened our long-term platform with investment in R&D and manufacturing, with additional manufacturing line in high-growth categories are being commercialized and expected to contribute meaningful to revenue and margins. A key milestone was securing a 15 years long-term agreement. This reinforces our capabilities and enhance revenue visibility for us in the long term. Advance funding of rupees 51.4 crore has already been received, reflecting strong customer confidence. Our plant facilities operated at above 60% utilization in FY26 due to the various challenges what we have faced. With improving sentiment and enhanced customer engagement, we target over 75% utilization in FY27, supporting EBITDA margin expansion. For FY27, the company has planned a capex of rupees 125 crore, which will be completely funded through internal accruals. Our R&D facility, completed in October 25, is now fully operational, accelerating innovation and strengthening our portfolio. In these challenging times, I would thank our investor for their continued faith and trust in Yasho. We continue to work towards building a strong business and increasing shareholder value over the long term. With this, I hand over to our CFO, Mr. Chirag Shah, for the detailed financial updates.
Thank you, Parag bhai, and good evening, everyone. I will now take you through the financial highlights for Q4 and FY26. For Q4 FY26, revenue was rupees 246.72 crores, up 33% year-on-year. EBITDA stood at rupees 44.71 crores with margin at 18.1%, reflecting 23.7% growth. This was driven by improved execution, cost management, sourcing efficiencies, and plant productivity. For FY26, volume growth was 33% year-on-year, supported by stronger customer traction and scale-up across categories. Industrial chemicals contributed 87% of revenue for both the quarter and the full year, while exports accounted for 62%, underscoring resilience despite global challenges. In FY26, the company generated positive cash from operations of rupees 152.75 crores. Financial discipline remained strong, with net to EBITDA improving to 3.75 times from 4.70 in FY25. We also prepaid rupees 23.30 crores of FY27 liabilities, leaving only rupees 15.6 crores due, easing repayment pressure and enhancing flexibility. CapEx for the year FY26 was rupees 75 crore. For our long-term contract signed in FY26, we received an advance of rupees 51.4 crore with execution progressing as planned. We expect the revenue from this to start realizing in FY28. With improving demand, strong operations, and continued financial discipline, we are well positioned to deliver consistent and profitable growth to our investors. Thank you, and we now welcome your questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Dheeraj Kumar Reddy from Alpha Square. Please go ahead.
Sir, thanks for the opportunity. Sir, I just wanted to understand what kind of, why are we seeing this 1,500 crore revenue target to be achieved by FY28? What is fundamentally driving this, and what are the kind of molecules which we are working in order to build our capabilities?
Well, first and foremost, we are expecting to utilize our assets by FY28 by optimal. When we say optimal, 85 to 90%. That will drive us. Also in FY28, the special project where we got the advance, which will come in commercial operation. So that will also add to it, and that gives us confidence. Besides, when we talk about the new molecules, we are working on a number of applications besides our traditional business, that's rubber lube, working on many chemistries, so that should also add to the top line.
Got it. So, sir, beyond 2028, like what kind of areas are we working? Beyond rubber, what are the additional categories which the company is currently focusing on in terms of R&D?
I cannot get too much into that, but I can tell you we are working more into the performance chemicals, which can drive the future growth of the company. Also, besides our traditional field where we are working today.
So it is not rubber. You mean it is ex-rubber, it could be semiconductors or anything. I'm just guessing it. So
I don't want to name it, but I don't want to give a wrong hope or feedback to you that we work on a semiconductor, we work on a data center. No, we don't do all that thing. We are purely chemical producers. We are the B2B. We are not in B2C segment. So, and we are working on an industrial segment on a different applications.
Got it, sir. Thanks. I will join back.
Thank you.
Thank you. Before we move to the next question, a reminder to the participants to ask a question, you may press star and one. Next question is from the line of Parikshit Gujarati from Niveshaay. Please go ahead.
Hello.
Hello.
Yes, please go ahead. You
Am I
are
audible?
Yes.
Yeah. So thank you for this opportunity, sir. So my first question is, previously you mentioned that all the revenue growth has come from the volume growth of 33%. So there is no price growth, means you have not seen any growth in the sales due to currency depreciation of INR against USD and Euro?
Well, there was a very, very minor, as you know, we also import equivalent quantity of raw materials from overseas. So that again will always nullify. There will be a slightly more edge on export side, but if you look at net to net, there is import export and a little bit extra on export side. So I won't say that the currency pricing depreciation can help. Yes, it do help to some extent. The company always measures growth in terms of a volume, what we sell, rather than a value, because value is always a volatile in current situation. There is also a lot of pricing pressure due to the various factors had in FY26. So the prices were always under pressure and margin was also under pressure.
Okay, so perfect. So my second question is, so many of our raw materials are linked to petrochemical derivatives, right? And also crude prices have moved up significantly due to this global crisis. So I want to ask that how does crude movement impact our margins? Because if you look at YOY basis, our margins were not hit that high. Well,
Yeah, I think that
help margins.
I will give that credit to my sourcing team greatly, how they maneuvered the supply chain. Also, with some product mix also that has been negative. The low margin product has not been pursued, but the reasonable margin product has been pursued here. So yes, it's a mix of a lot of the effort from sourcing team, manufacturing team, sales team, everybody together help us to remain afloat and to hold on our margins.
Okay, perfect. And sir, my last question is that, so without naming any customer, for the order which you have got from the big MNC player, so if that order gets completed on time successfully, so there are other big additive players which are expanding into India, their operations. So can they be open to our customer as well in the next 3-4 years?
Yes, very much.
Okay, got it. Thank you so much.
Thank you.
Thank you. Participants, to join the question queue, you may press star and one. Next question is from the line of Naeem Patel from Bastion Research. Please go ahead.
Hi, thank you for this opportunity and congratulations on good set of numbers. So my first question was on the EBITDA margin side. So historically, Yasho has guided for 17 to 19% guidance, and now so is it in the same band, or like are we expecting now 20% plus, or any color on that?
I think I have already mentioned that we are looking for the better margins for compared to this year. So yes, we are expecting at least 2-3% higher EBITDA compared to what we had, purely because of the operational efficiency. When we are driving up the utilization beyond the 70%, we should able to rationalize a lot of cost.
Understood. And, considering the tariffs has moderated compared to Q2 as well as Q1, and Q4 now has the customer base from US, what is the response on that side? And like, how are we looking into the America geography for FY27? If you could highlight on that.
Well, definitely the tariff has helped us to expand our sales in Q4, and that can see in the results. And we believe that that America's market is growing very well for us, even in this quarter too.
And for FY27 onwards also, we believe there are steady responses. Is that correct?
I think, yes, very much.
And just to follow up on the geographic front as well, we are seeing some slowdown in the European economy, and Europe is also one of our key markets. And now we are targeting our capacity utilization to ramp up to 75%, as well as this supply side disruption from Strait of Hormuz. So, like, how are we going to navigate to achieve this target of 75% utilization, considering these dynamics?
I know one side we see that the slowdown in Europe, and second time some segment we see the good demand coming up to us. Besides Europe, we also venturing into the Asian market, which was not highly penetrated by us. And third, the America's market is opening up, so that will also help us to achieve the better utilization.
Understood. Yes. Okay, that's all from my side. Thank you very much.
Thank you.
Best of luck. Yeah, thank you.
Thank you.
Thank you. Next question is from the line of Harshit Singhania from Robo Capital. Please go ahead.
Hello, am I audible?
Yes.
Yes, please go ahead.
Yeah. Thank you for the opportunity and congratulations on a great set of results. Just a few questions. So, you've guided that the peak potential of both the plants combined is around 1450 crores. So that is as per the existing capacities?
Yes.
Okay, and the Pakistan plant has further potential to land on which there can be development?
Yes.
Great. And right now we are taking an active effort of not taking much more debt. So can that be assumed like for 27, 28 both, that the debt levels are going to be on the lower end only?
I won't assure that. What we are assuring is the debt to EBITDA ratio to come down, and our comfort zone will be in the 2.5 times. That's what we want to draw. So first achieve that, and then we'll talk about the debt. Till then, we don't want to talk about the increase in the debt. Absolute number could rise, but when you look at the ratio point of view, it will remain in that.
Okay, great. That's it from my side. Thank you so much.
Thank you.
Thank you. Next question is from the line of Arnav from Inga Ventures. Please go ahead.
Good afternoon, sir. Shivam this side. So I just wanted to understand on the domestic demand that was well aided in Q3 and Q4 both, despite exports being on the lower side. So is this domestic demand coming from a new set of customers, or is there an existing customer's demand ramped up? And which segment that is contributing to this domestic front, sir?
Domestic front is driven mainly by industrial segment. That is growing very well for us. We have added some few customers, and existing customers also increase the share from us. Maybe they might be having a supply issue from some other existing supplier, so we have got opportunity to cater them. So multiple factors help us to expand our reach domestically also, and we hope that we continue that with the speed.
So expect this demand from this new set of customers and even the existing set of customers from domestic to continue. And so one more point on this, what I've observed this particular quarter, that despite having a higher domestic share, the margins have improved. So do you see this trend keep continuing despite higher contribution from domestic, the margins will be there?
I think so, it will be. What drove the margin is the better utilization in a Q4. That will help us to achieve. And if we are going to utilize our plant capacity to 70%-75%, that will also improve the margin further up. And that's why we are giving a guidance of improve EBITDA to 20 or so.
Fair, sir. And sir, final question. In the industrial segment, anything that you can highlight, whether it was rubber or lube additives, which was contributing?
I think all segments are doing quite good for us.
Fair, sir. Thank you so much.
Thank you. Thank you.
Thank you. Next question is from the line of Rupesh Tatia from Long Equity Partners. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations on good results. Sir, I have very basic question. I'm relatively new to the company. Can you tell me what percentage of your revenue come from automotive engine oils and what percentage comes from, industrial engine oils? And with the EV penetration, what kind of risk do you see to our portfolio?
Okay. Let me be honest, I don't have how much my customer use for automobile or industrial. We don't have that data. Second question is on our EV. Yes, EV is increasing, but we don't see that risk for next 15 to 20 years. That could be a reality down the line, but not in next 5-10 years. EV could be a threat to the lubricant industry. Number three, besides the automotive, industrial segment of lubricants is also growing rapidly due to the data center, due to the solar, or due to turbine or the wind power. So there is also increasing demand happening. So we are capturing all these segments. So I don't see a big threat in a near to the medium to long term, 10-15 years horizon. We don't see a threat on our business of lubricant.
Okay. The second question, sir, is there any area in which we make our own formulation for lubricant and sell that? Because what I understand is formulation is a bit hard, it's proprietary and probably higher margin. So any idea about what percentage of our revenue comes from formulations, how we are looking at it?
Yasho don't do any formulation. Yasho only make the pure chemicals. So all Yasho's customers are who make formulation, and we don't compete with our customer. That's the policy of the Yasho. So we don't have any intention to go in that direction.
Okay. That is very clear. And sir, the final question is, the current Pakhajan plant, we are currently in phase 1, but in the past you have also talked about doing phase 2, and phase 2 will be sort of like a brownfield capex. So at what point do you start looking at phase 2? What kind of products will you do there? Any comments on that?
I don't have phase 2 today because that's ongoing. In FY26 also, we spent about 40 crores in Pakhajan as an additional capex. We have a special project running that is about 90 crore capex in this year. And additional, we are looking at 100 crore capex in Pakhajan. So that's an ongoing process that will continue till we totally exhaust our land available to manufacture.
So your capacity went from 12,000 to 32,000. What is the capacity now, and what is the maximum that we can go to?
Well, I don't
consumed.
Honestly speaking, I don't know what is my current capacity, but I can tell you in Pakhajan we have made 2 in a production building, and we can build additional 4 production building. So that 4 building will be start constructed one by one as we see the ramp up or the additional demand coming in.
Okay. Good. Thank you for answering my question, sir.
Yeah. Thank you.
Thank you. Next question is from the line of Chintan Shah from JM Financial Family Office. Please go ahead.
Thank you so much for the opportunity. Mr. Parag, I was just going through the presentation and, we sort of changed the language there. So now you mentioned that we are an emerging global specialty chemical partner to MNCs. and plus, we are doing a lot more investment on the R&D side. So just wondering, as a strategy, is it changing more towards a sort of a CDMO a model? And just wanted to understand, is this more customer driven, or what exactly is happening that is driving this change? And if you were to think about it, for 4 to 5 years down the line, how will the company evolve? Would we see a much higher mix, a much CDMO-driven contracts versus the products that we manufacture on our own?
Yasho is not governed for the CDMO kind of work, but we don't mind we don't mind leveraging our capability to tie up with some big user who is looking to source large volume from Yasho. Okay? So that's my answer.
Okay. Okay. Got it. Understood. That's all I have.
Thank you. Thank you.
Thank you. Next question is from the line of Ankur from Axis Capital. Please go ahead.
Yeah. Hi, sir. Thanks for the opportunity. First question, in our presentation, we are guiding for a 1,500 crore revenue by FY28. So, what sort of, visibility here do we have? Is it largely contracted with respect to the customer's demand, ramp up, et cetera? You did allude towards, ramping up your existing capacities. But, how is the demand visibility there?
I think with the more penetration with the customers and the expanding of our customer base, which is helping us to grow the market, with the current challenges, we are able to gain confidence of our customers who are a little bit, conscious that whether far away from India, the supplier can support us or not. That we have proven even in the difficult time of this. So that is helping us with some customer commitment coming to us on the table, which is helping us to give a guidance of 70-75% utilization. And if you achieve 75% utilization, that is more 15% than what we had today. It will be that will give us confidence, and also the project which we are doing with one exclusive customer, that will also start kicking in from early FY28. So all these things will help us to achieve 1,500 crore revenue in FY28.
Sure, sir. Just a follow-up here. The commitment and, the customer ramp-up that you are referring to, this is largely a same product, going to more number of customers and geographies, or these are new products also which are going to the existing ones?
Well, the relationship what we built with the new customer is exclusive to them. So that cannot be shared to anybody. It's but similar chemistry we are also doing, and that can be shared to all the customers across the board.
Sure, sir. That's helpful. And secondly, on our working capital, if you can, share some thoughts there. We used to be 120, 150-day working capital, but of late there is an increase. So if you can just help us, better understand how to look at that part.
I think we were at the 200 odd days in FY25, but 215, 216 days, we have brought it down to 190 days today. Our debtors are constant. That has not increased. Only the stock has dropped to some extent. That will help us. And let me be honest, higher stock has helped us a lot in this crisis. That was blessing in disguise to us. Okay? So we could navigate very well with the last 3 months supply challenges of raw material. Since we had enough stock, we could manage it well. So if you ask me today how much you want to reduce, I said I'm happy, but it will come down as a number of days, but as a absolute number it will remain same. So we would like to bring it down to 175, 170 in the next 6 to 12 months, rather than drastically bringing down and wait for a raw material to have a production.
Sure, sir. That's helpful. Thank you for all the answers and all the best.
Thank you.
Thank you.
Thank you. Next question is from the line of Dheeraj Kumar Reddy from Alpha Square. Please go ahead.
Sir, in
Hello?
elaborate the CDMO model with you. Hello? Hello. Sir, am I audible? Hello?
Yes.
Hello. Sir, in the previous participant's question, can you just again touch upon the CDMO model? Because historically, company has been evolving, moving away from commodity to entering into more complex areas. Can you just elaborate that answer again?
Well, CDMO is something which is done in more on, API segment and those kind of segment. We are not in that segment here. We are not here to cater for a smaller volume kind of a thing. Somebody wants 20 metric ton, 100 metric ton. I don't think so. Yasho is there to do that kind of a model. We have a design Pakhajan looking into the molecule which we can produce at least 500 to 1,000 metric ton minimum and then take it up from there. So we are not looking at a CDMO style, but yes, we are looking for a cooperation with the customer who are looking for a larger volume which they want to source from us. Yes, we are there for that.
Understood. Sir, also in one of the interviews, you mentioned that beyond 28, the idea is to ramp up the current 2 facilities to probably 4, 5, 6 facilities, right? Sir, how do you see that journey coming there? What will drive that? What are the kind of areas which company, at least if you can touch upon like what, I mean, how is the company foreseeing that growth curve beyond 28 is what we would like to understand it from you.
Well, beyond 28, we have a lot of molecules which we think that will help us to grow. Beyond that, or even also our existing product, there are certain opportunities where we can go further. So we will like to do a dual. So we will look at the product portfolio from where we can increase. And number 2, we are in a process of introducing more chemistry in our portfolio. So that will also help us to grow.
Understood, sir. And our strategy of entering into one molecule is more like replacing so any Indian customer is already doing it, or it's only us who is actually supplying it to this MNC from an Indian geography standpoint? And what is the typical market size of each molecule, sir?
Well, we are looking at each molecule nothing less than 50 crores, at least to add to our top line. Otherwise, we are not interested to look at some molecule which just give a revenue of 5 crores. When you are looking at the 1,500 crores and adding a molecule of a 5-10 crores revenue, does it going to help us? No, my dear friend. So we need to look at the molecule which gives at least 50 crores revenue to work in R&D is much more meaningful. Because R&D takes a lot of resources, not only the human, also financial resources. So we need to be very careful where we are going to spend our money.
Understood. And what about this Indian geography competition? Sorry, are we sole supplier for these molecules, or are there any other?
Always there is a competition. Always there is a competition. You cannot claim that you are a sole. It could be that one of the product I could be sold today, tomorrow there could be some more producer. So you cannot claim that, and that's not. I would like to comment on it.
Understood, sir. Thanks a lot.
Thank you.
Thank you. Next question is from the line of Agastya Dave from CAO Capital. Please go ahead.
Hello, good afternoon. Am I audible?
Yeah.
Thank you very much for the opportunity, sir. So most of my questions have been answered. One question that I had was, is there any sort of disruption or dislocation in the supply chain, either from your raw material side or the end user side, or in the space of your competition, which you can point out as of now because of the problems in Middle East?
Well, I can give n number of points. Number 1, lot of our imports are getting delayed, which generally typically takes 3 to 4 weeks. At times it's taking more than 8 to 12 weeks to get the product. So that's one of the biggest challenge. At times we don't know where our import containers are lying. And then those are the challenges. Even to when we are exporting, earlier days to the USA was only 25 days. Today it takes more than 60, 70 days to reach the container to USA. So those are the challenges we are facing today.
But number 2, These
Number
are just
three,
timing issues or, sir, the quantity, the supply itself is missing. Will this sooner or later become a volume issue?
well, this will at times cause a problem at our end that we have been stuck with a lot of material because it's not been moving out quickly. Or
Right.
sometimes we are waiting for one of the key raw material which is not coming, so the production is hampered. Or you have to buy at a different price from the market. So there are multiple challenges come. And the number three, the challenges because of this chemical challenges, lot of raw materials are not available or available at a very fancy price. So one has to take a decision, can you afford to buy that price or you have to wait. So there are multiple challenges today we have. And some of the challenges have been mitigated by having a very high inventory.
So, just last question just to elaborate this point. So is there a particular time by when this problem becomes a really big problem and you won't be able to substitute or wait long enough? I mean, when do the volumes really dry up? Of the things
Let me be honest. Neither I have a crystal ball nor I have a source from a White House which can give me that information what's going to happen tomorrow.
Right.
Yeah.
Right. Okay. Okay,
Thank
sir.
you.
Thank you very much, sir. All the best, sir. All the best.
Thank you.
Thank you. Next question is from the line of Poojan Shah from Molecule Ventures. Please go ahead.
Thanks for the opportunity, sir. My first question pertains to, can you give us some sense on the volume part in Q4 FY26?
Well, we already said that we are in FY26, we have grown by 33%. And in volume terms, and in the next year, FY27, we are expecting to grow by utilization to grow by 15% or so, and the volume growth should be somewhere in the range of 40 to 50%. Again, we should gain that growth.
Sir, why I'm asking you the question is I just want to understand on the development chemical side. So, due to all this small situation.
Sorry to interrupt, you are not clear. Can you go slow?
Yeah, just hold on. Am I clear now, sir?
Yes.
Yes. Okay. So my first the question why I'm asking is I just want to understand because we have seen quite a bit of increasing prices of the chemicals. Obviously, the base chemicals and even the lubricant chemicals have been increasing the prices in terms of China and our competitors. So just want to understand how these prices have been sustainable going across for a year or two, and how we are seeing because we are being benefited by the two things. One, hello.
Yeah. Well,
Yeah.
First and foremost, again, I said I don't have crystal ball. How long this will continue, what will happen, nobody can answer that today. So I have no idea about when the price will normalize. Absolutely no idea. I cannot comment on that part of it.
Yeah, I agree. But my question pertains to how much percentage of price increase we have seen from the base like pre-war era to right now in current state.
About 10 to 15%.
10 to 15%. Okay. And are we getting any benefits of being the yen appreciation or rupee depreciation altogether? So that will ultimately expense out more on the imports that will ultimately help, which we have been seeing in the domestic growth. Is that can be a call we should take, or it is more on the product quality and the working capital of what they like to manage because ultimately shipments are being delayed right now?
There are multiple reasons can influence that. Number one, availability. Number two, how much you can pass on when the prices are increasing or margin always come under pressure. One cannot pass on 100%. One has to absorb something because of the relationship or whatever the nature or what kind of contractual you have with the customer. So there are multiple reasons and one cannot say that what's going to happen tomorrow. So we are a little bit cautious on that side.
Okay, got it, sir. Got it. That's all from my side.
Thank you. Thank you.
Thank you. Next question is from the line of Anupam Agrawal from Lucky Investments. Please go ahead.
Thank you for taking my question. Sir, I just missed your comment on the CapEx that you have done in FY26 across Vapi, Pakhajan, and the new project. And what will be the CapEx in FY27 for different projects?
Well, FY26, we spent about 75 crore. 25 crore we spent on R&D, about 42 crores on Pakhajan, and about 7-8 crores into the Vapi. Vapi was mainly for some adjustment into the new product. When you introduce, you need to do some CapEx. So that's the reason. In FY27, we are looking at about 125 crore CapEx. That will be purely done at the Pakhajan.
And what will be the share of our CapEx for this MNC project?
0.
Okay. Understood. My second question, sir, just alluding to your comment to the earlier participant, 15% increase in utilization will translate to 40 to 50% volume growth?
30 to 40 depends. See that this is a product mix. What product which we sell, everything depends on that. But anything between 30 to 45% volume growth will happen.
Got it, sir. Thank you so much, sir.
Thank you.
Thank you. Next question is from the line of Manjit Buaria from Samya Advisors LLP. Please go ahead.
Parag, thank you for taking my question. Would it be possible to share what percent of our revenue in Q4 came from long-term contracts versus spot market out of the 246 crores, and the same ratio for the full year 26?
Well, in Q4, it's a regular business, what we had from Q1, Q2, Q3. So there could be some new customer added there in Q4, but mainly from our regular customer only the businesses came up. And that was has helped us to grow the business.
Right, sir. And I was just trying to understand, I thought there were certain long-term contracts you were looking at, and then there were certain business you were doing the spot market. So is there a ratio within that which you can share, or it's not possible?
That's long-term. When you say long-term, we have customers who buy on a regular basis. They buy either quarterly pricing or 6-monthly pricing. So that is about 40% of the revenue, and balance 60% come from spot, what you call, or the customer with whom we have relations over time, and they buy as and when they require.
Thank you very much. And Parag, the second question was, over the next 2 or 3 years, as the mix of our products goes up, the value addition in our products, right? Will our gross margin also inch up from the 40% in FY26, or is 40% the right level to think about?
I think 40, anything between 48 to 42% should be the right guidance. What will help us as we are going to do more utilization of all the assets, that will help us to leverage all our expenses, fixed expenses, and that will come down drastically, and which will also help us to improve our margins.
Got it, sir. And the last question, sir, I missed your response in the earlier question. Out of the 125 crore capex for FY27, how much is going to be funded by the, strategic contract we have versus, ourselves? I missed that response, sorry.
Oh, no. 125 has nothing to do with the strategy. That's a separate capex altogether. That has nothing to do with 125 crore. 125 crore is purely done by Yasho Industries, by its internal accruals, for this product which we want to launch new, or where we want to expand further.
Got it, sir. Thank you so much.
Thank you.
Thank you. Participants, to ask a question, you may press star and 1. Next question is from the line of Yash Mehta from SKP Capital. Please go ahead.
So thank you so much for the opportunity, first of all. So I've got a few questions. So the first is, how should investors think about competitive intensity from Chinese suppliers going ahead, especially in brand, lubricant, additives, and industrial chemicals?
Strong. Very strong. They are very, very competitive, and they do come hard.
Okay. And Yasho has also mentioned strong demand visibility from Europe. So has the India-EU trade opportunity resulted in better customer engagement and improved competitiveness or new inquiries from European customers?
Well, first and foremost, India, Europe, and treaty FTA will come in place only by early January. Hopefully, we are hopeful that will come in by early January. So today, what we see is our existing relationship, which is helping us to grow. Also, we have our team on the ground in Europe. Now they are almost a 1-year-old team, so they are getting more mature, and we are confident that they will be able to deliver much better results to us.
Okay. Yeah, got it. Thank you.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and one. Participants, if you wish to join the question queue, you may press star and one. Next question is from the line of Karan Gupta from Acmil. Please go ahead.
Yeah. So my question is regarding the 28 guidance of 1,500 crore, approx 1,500 crore. What are the capacity expansion we've included in that? The Vapi and your Pakhajan is included in that? Or
Yeah, Vapi. When we talk about 1,500, the capacity expansion, what we did in FY26 is included in that. FY27 could give some leverage for FY28. Definitely will give some leverage in FY28. And also the long-term contract which is signed will give us a leverage in FY28.
Okay. And the margins will be maintained?
Yes, absolutely. Margin will be maintained.
Okay. And any sector-wise growth you can share? Segment-wise sector growth you can share?
Sorry, I can't hear you properly.
In this,
Karan, request you to please use your handset. Your voice is not clear. You are not audible clearly.
Now I think it's audible.
Yes, please go ahead.
Yeah. So this 33% of volume growth, if you can share the breakup, your maybe product-wise, maybe industry-wise.
Well, the maximum volume growth or entire volume growth has come from industrial segment. I can give that much breakup to you. And whatever we gain is on while there could be a slightly deep into our consumer side.
Okay.
Yeah.
And the price we've taken, I think you said 10 to 15%, if I'm correct.
That has not happened. That has not happened across the year. That has only happened now. Price growth. And maybe happened in the last 10 days of March. Earlier, the price growth was not there. Price growth is now really kicking from April onwards. Because till March, we already have fixed prices with customers. So we change price every quarterly for 6 months with our major customers.
Okay. And just last one on the geopolitical scenario side. Having this geopolitical backdrop, how you're seeing the Q1, Q2 in terms of growth?
I have no clue on the crude side because I don't track that, honestly. Yeah, but we see that the price volatility in our couple of solvents, strong volatility, some chemistry of sulfur-based chemistry, we see the strong volatility. But besides that, prices are quite stable.
Okay, we are optimistic about the volume growth then.
Yes, absolutely.
Any guidance you can give on the volume side?
We already said that we will grow by about 15% on capacity utilization, and volumes are between 35 to 45%. Volume growth also will happen in FY27.
Sorry, 30 to 35%.
35 to 45%.
35 to 45% volume you are saying, and 15% on the capacity addition side.
Yes.
Okay. Thank you.
Thank you.
Thank you. Next question is from the line of Nikhil Porwal from Perpetual Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Parag bhai, my first question is just a clarification. So the 125 crore CapEx for FY27, it doesn't include the CapEx for the MNC,
No.
which is ongoing, right?
No.
Okay. And once the plant for the MNC commercializes in 28, all these advances will be set off against future deliveries.
Yes.
Okay. And last question is on any problem on availability of sulfur?
There is a challenge. I won't say there is a problem, but there is a challenge to get what we need.
Okay. But the
Availability is there.
you're confident?
Yes.
Okay. I hope the higher inventories is helping you in this volatile environment now.
Yeah, to some extent, but we don't hold sulfur, unfortunately, so much quantity. One of the cheapest raw material in our portfolio.
Okay. Okay. Yeah, that is it from me. All the best.
Thank you. Thank you.
Thank you. Next question is from the line of Lavina Jagwani from Spark Capital. Please go ahead.
Hello, sir. Just one question from my side. What is the current capacity utilization between Vapi and Pakhajan?
Well, for March, we utilized more than 60%, anything between 60-62% utilization upon until March FY26. That was utilization. Currently, the status is in current quarter, it's been improving, but I don't have exact date, number of improvement, how much we have improved.
What will be the individual capacity utilization like for each plant?
Well, let me be honest, we will always talk about the Yasho level rather than I'll talk about the individual capacity level. So I like to stick to the Yasho level capacity.
Okay. Okay. Thank you, sir. Thank you, sir.
Thank you.
Thank you. Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for the closing comments.
Thank you very much, everyone, joining this call. I appreciate your time. Thank you. Have a good day.
Thank you, sir. On behalf of Yasho Industries, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.